Welcome, everyone. I'm Jason Kirby, founder and managing director of Thunder.vc, and today we have Justin Renfro joining us from WeFunder here to talk about crowdfunding, but a different spin on crowdfunding, being revenue-based financed solution that creates a win-win for both investors and companies to get capital now and to leverage their communities to do so. The plan for today is Justin's going to give us an education on how founders can basically leverage this and give us a little more context on how it came about and how they can, one, qualify and make it relevant to them and potentially leverage this as an alternative financing solution for their business and who would be a good fit for that. We're happy to open up for questions. If you have questions throughout the presentation, you can ask at any point in time. If you want to ask it verbally, you can just use the chat feature to do so, or you can use the raise hand feature. But without further ado, Justin, I would love for you to kick things off with a little bit of context to your background and what you do at WeFunder, and then would love to take it from there and get into the meat of it. Does that sound good?
Yeah, absolutely. It's a pleasure to be here. Thanks for having me, Jason. I have been working at WeFunder for 4 years, helping entrepreneurs raise capital. But my experience as an entrepreneur and helping entrepreneurs spans back to my first job out of college, which was at a nonprofit called Kiva. Kiva facilitated 0% interest microloans all over the world. And I joined Kiva in 2011 to help launch the Kiva offering in the United States. So I spent 5 years going around the country launching Kiva cities, where we would go in and help entrepreneurs get that first layer of capital. So if you think about a capital stack and a funding journey, there's many, many stages of that. This was the very first, $5,000 to $10,000 0% interest microloans that were crowdfunded on the Kiva website. When I was at Kiva, I spoke to an entrepreneur who was telling me his story, which was essentially, I worked on Wall Street, I got sick of it, I moved to Florida, I bought a boat, and I started a boat charter business. And that resonated with me. I was like, that's entrepreneurship through my lens. I love that. And that seed just sat with me for a long time, up until the point where I quit my job at Kiva, moved to San Diego, and started my own boat charter business. So over the past 6 years, I've been running boat parties in San Diego through my business. It's chillcharters.com. And really got to see what entrepreneurship is all about, at the ground level. Raised a round of capital, built a brand from the ground up. It was a very rich experience, and I continue to be challenged and forced to think entrepreneurially about how to sustain and grow that business. When I started my boat business, my team from Kiva moved to WeFunder. So WeFunder really is the leadership of WeFunder really stems from the work at Kiva. So there's a heavy mission component. We're a public benefit corporation, and we're really designed to even the playing field and help more entrepreneurs be able to raise capital. The mission behind WeFunder is to democratize startup investing. And that applies to both startups and investors. And when I started at WeFunder, it was really designed around go find awesome founders, help them raise capital. And, WeFunder provided the infrastructure for founders to be able to raise capital. So when you think about crowdfunding and what is a platform like WeFunder designed around, it's really designed to give the infrastructure for fundraising so that entrepreneurs can expand the scope of who might be an investor, whereas opposed to it's just angels and VCs. Now it's your customers can invest, friends and family can invest, your professional network can invest. We're broadening the scope for who can invest. And WeFunder as an infrastructure kind of provides ease and simplicity around the fundraising process and being able to bring in a lot of different people to invest and to organize all of those investors, all of those investment contracts, all the legal and compliance in one central place. I think that's probably the most misunderstood and under-indexed thing about what WeFunder provides is really the infrastructure. Most of my time at WeFunder has been spent helping entrepreneurs raise equity capital. These are generally seed stage companies that are stitching together capital rounds to get to an institutional raise at Series A. And in 2020 and 2021, the markets were very frothy. There was a lot of money being cycled to entrepreneurs. Generally, it was working. You know, if you were a consumer packaged goods company or a brewery, you know, it was, you know, capital was flowing. Our average raise was $450K, and it was working. But in the middle of last year, the market started to kind of dip, and it's been a very challenging fundraising environment over the past year. And I've seen really awesome founders really spinning their wheels. They're stuck in the mud. They're frustrated that the capital isn't flowing. And it was much easier 2 years ago than it is today in terms of being able to stitch together a round. In Q1 of this year, I went and spoke to 100 VCs. And my goal was to really understand, who are they? What are they looking for? How can we add value? What types, you know, how can we facilitate richer connections between venture capitalists and founders? How can we build out, you know, be contributors within this ecosystem? And my core learning was a lot of venture capitalists, almost all venture capitalists, are looking for the same thing. They're looking for companies that can grow very, very fast. They're looking for companies that could get to $1 billion valuation. They're looking for companies that could get to 100 million in revenue. They're looking for companies that have huge upside. And there's two important pieces to venture capital that I think most people need to understand. The first is venture scale, a company's ability to grow exponentially. So most companies are on a linear path. You know, for simplicity's sake, let's say I sell a granola bar. It's just like, as I sell more granola bars, my costs go up. I have more raw materials. I have more production costs. So it's linear growth. Most venture capitalists are looking for companies that, you know, when I think of exponential growth and that spectrum, it's really designed around being able to replicate what you do without adding additional costs. So a lot of venture capitalists are looking for enterprise SaaS, where the ability to just shell out more licenses and collect more money requires minimal additional costs. And the second piece to the venture model that I think is an important concept to understand is the power law framework. The power law framework essentially says any one of the bets that I make have the potential to pay off all of the rest. So if I make 50 investments, I only need one to succeed to pay off all of the rest of the bets that I've made. And what they're looking for are companies with $1 billion plus potential, companies that have that scope where they could get to 100 million in revenue, or they can get to $1 billion exit. And in reality, for most companies, that is not realistic. That is not how the company is designed. And $1 billion is way out of scope in terms of where that startup is at. And I think that venture capital is far more narrow than most entrepreneurs understand. If you fundamentally understand this framework of venture scale and the power law framework and how those are applied in practice, the vast majority of VCs are looking for those types of companies. And there's nothing wrong with that. I am not anti-VC. I just believe that VC is far more narrow than people understand. And so my objective was to try and find new ways that new financing structures for startups that might make more sense, that might be kind of tangential to venture, but not quite on that exact venture track. And I landed on revenue-based financing as a very pragmatic approach to startup fundraising, where liquidity is rooted in the contract. Investors see a return. There isn't this expectation of a 100x return or a billion-dollar company. The expectation is a more modest upside for the investor and a better exchange of risk and reward between founder and investor. So I've been running with this revenue-based financing product at WeFunder, and that is my primary focus at this time.
You know, Justin, I'm really glad you kind of gave the context of the difference between like what venture capitalists look for versus, you know, what founders actually need. I think there's this huge misconception of, well, I need money, so it must be venture capital. And that's not necessarily always the case. And I think you hit on some really good points of the differentiations there. And I think for the audience here and people watching us on LinkedIn, I think it'd be really great for you to kind of break down, you know, there's revenue-based financing solutions already out there. There's platforms that you could apply for and try to go through those processes, and you could potentially get some capital that way. But, you know, why should people try to raise it through the crowd, and kind of how does it work? You know, because that's obviously a very different offering than, you know, kind of invest $500 as a retail investor and have equity, and maybe you get paid out someday, maybe you don't, you don't really know. But with revenue-based finance, it's a little bit different, especially from the investor side. So if you can kind of walk everyone through kind of how it works so they have a better idea, I think that'd be super helpful.
Yeah, so let's look at it from the investor's perspective. I'll answer your first question after this around, you know, the merits of kind of opening it up to a broader crowd. But if we look at from an investor's perspective, if you invest on an equity contract, more or less a safe or a convertible note, the only way typically that you are going to see a return is if the company gets acquired or if the company IPOs. So the pitch from a founder to an investor is rooted in this very philosophical conversation of, this is how I get big enough where I get acquired. It's very philosophical in nature. From an investor standpoint, through the revenue-based financing function, the way it works in practice is the founder, and this is how it works on WeFunder. There's many variations of revenue-based financing out there, and there's a lot of good resources out there. You as the founder are offering the investor a 2x on their investment. So if they invest $100,000, they're going to see $200,000, and the target repayment is 4 to 5 years. So in 4 to 5 years, the investor is expecting to double his money. The way in which he doubles his money is by revenue payments from the company. So every quarter, the founder allocates a percentage of their revenues to pay back to investors. So call it 5% of revenues. So every quarter, 5% of revenues are paid back to investors until they realize a 2x on their investment. Now, through the lens of the investor, now it's not a philosophical conversation of how does this company get big enough where they get acquired? The conversation is, what was their revenue history? What are their revenue projections? Is this a realistic growth curve? Will this company grow over the next couple of years to the extent that I can realize a 2x in 4 years? So now you're looking at the economics of the business model, the revenue projections to determine if this is a good bet for a 2x. Now, again, on equity, it's illiquid, meaning you can't access that capital unless there's an acquisition or an IPO. In this revenue-based financing model, entrepreneurs will be paying back quarterly. So you're going to start seeing money back on your principal, within 6 months. So it's a liquid investment. And that to me is a more attractive option for retail investors. So that kind of bleeds into the second question of like, if you're going and talking to a venture fund, they're uncompelled by a 2x. They have a thesis for this pool of money that they have. They're making big bets. But for my friends, for my customers, their ability to get a 2x based on the success of my business and having that be kind of a more a tight feedback loop between founder and investor, where I'm seeing the growth of the business with revenue payments coming back and me getting liquidated on my investment in the short term. It's a fundamentally different scope from an investor standpoint. And I believe that, for a lot of companies that are in that early stage, a lot of the early stage financing comes from solo angels, comes from friends and family. WeFunder and the merits of crowdfunding are, you can open that up. So it's not just angel investors with 25K checks. It could be friends and family. It can be your customers. It can be a broader group. So you can accumulate that capital from more people in smaller chunks, which in theory should help you be able to raise the capital faster if you're able to accept investments from a broader group of people.
So when it comes to the founder, you kind of mentioned some of the toggles or things you can adjust. But if you can kind of clearly outline, like, so if I'm starting I'm running a company, we're generating revenue. I'm basically, in a way, pledging a percentage of my revenue that's going to go back, to the WeFunder investors and give them return. I guess, what can I control as far as timeline, payments? What if there's a hiccup in my revenue or cash flow or something like that? What controls do I have as a founder when using something like this?
Yeah, so the most important piece is you articulate what is the multiple for the investor. So it could be a 1.5x, it could be a 2x, it could be a 3x. You're able to kind of design the offering. The more mature your company, the probably easier you can go on the multiple. If you're a pre-revenue startup, you might consider doing a higher multiple. So the multiple is one kind of variable factor that the founder selects. The other is the percentage of revenues. So typically it's about 5%. The range is like 3 to 10%. So if you have higher margins, you can afford a higher percentage of revenues. And that percentage of revenues is fixed. So every quarter you're cycling 10%, 5%, 3% of your quarterly revenues back to investors until that investor has realized the 2x. Now, if the business has a down quarter, you have a smaller payment because it's based on a fixed percentage of revenues. If your business is growing fast, it's going to be a higher percentage of revenues. So again, looking at it from the investor's perspective, they want to bet on a company that's going to be able to pay them back faster. They make more money if the company is growing fast. So you're kind of looking at the entire equation. It's like a math model. And I've got a framework that I work through with founders and investors and kind of thinking through the cost of capital, the revenue projections, and the payback period to investors. But that payback period is variable. You're basing the target on your revenue projections, but things could go faster, things could go slower. So that repayment period is variable. The founder continues to pay out a percentage of revenues until investors have realized the payback multiple that has been set.
And unpacking that a little bit more. So, company sets up the campaign, is successful, raises what they need to raise. They have their payment periods. How is WeFunder verifying revenue and processing the distributions to kind of protect the investor?
Yeah, so the revenue is self-reported by the founder, and the founder is asked to give a report of the revenues back to investors when they make the payment. WeFunder's product, again, thinking about WeFunder as an infrastructure, facilitates those payments. So the beauty of WeFunder is you just make one payment to WeFunder every quarter, and we distribute it equally across all of your investors. And so we've already got that built into our product.
Awesome. I know I'm asking questions here, but if anyone wants to chime in, they're welcome to do so. So when it comes to, all right, let's flip the perspective. Let's open this up from the investor perspective. So just an acknowledgement, crowd equity, in the majority of all crowd equity campaigns, it's the founders community or existing investors, or it's their network that's really bringing capital to the door. Albeit that's the same here with revenue-based financing, but like we saw in peer-to-peer lending and other kind of lending kind of democratized lending access sources, we start to see other players come in, and because they have access to the data, they have access to more of a financial decision as opposed to a let's hope these guys figure it out and have liquidities situation. This will open up a lot more investors to participate in the rounds because there's immediate cash flow, and it's less of a gamble with your principal. You're not going for the 100x, you're going for the 2x, but that 2x is statistically much more likely to happen based on which companies bet on. So what protections are in place for investors to not only participate, but to, in case there is any kind of hiccups, or if the founder misses a payment or is under reporting revenue, what kind of protections are in place for the investors?
So WeFunder takes a very unique approach to this topic. The capital is decentralized, meaning it's coming from a lot of different people. And that influences our perspective of how we underwrite these loans, how we design investor protections. 80% of the capital on average is coming from the founder's network, the founder's customers, the founder's friends, the founder's professional network. The idea is that if 80% of the capital is coming from the community of the founder, there are social incentives and social capital components to the repayment. The founder is not going to it. I think it's an easy sell to say like a founder could run away from a centralized institution. It's just a company, like you shouldn't do it, but you could. I think it's a different story when you consider where the capital is coming from. If the capital is coming from friends, if the capital is coming from customers, it's in the founder's best interest to do right by the investors. So we certainly have a team that's communicating with founders, that's talking about the payments, and we have a support layer to the WeFunder company around making sure that founders are doing right by their investors. But they're not protections. These are not secured. They're not kind of like tied to collateral. There's no personal guarantee. This is a much, much more friendly option on the founder side. And the capital is coming from people that they know. So the hope is that those investors are kind of that's where the 2x comes in. There's a healthy exchange of risk and reward. There's a reason that there isn't, these aren't 10% interest SBA loans. We're not competing with low interest secured SBA loans. We're trying to position ourselves in the middle of VCs and banks. So that 2x upside for the investors kind of factors in the risk and reward.
And I guess which founders should be pursuing this, and why should they choose this over alternative, revenue-based financing or other debt solutions?
I mean, I think it's just good to have options. I think it's good for founders to know what's out there and to have different options to choose from. I don't think this is a silver bullet. I think all options have pros and cons. I believe that, where WeFunder, where revenue-based financing is most relevant is companies that are in revenue. So I think that if you're pre-revenue in idea stage, there's less relevance to revenue-based financing. I think that if you have a good understanding of your revenue history, your economics, your cash flows, this is a much more kind of like rooted structure that gives you confidence that this makes sense within the business. So I think it's in both the founder and investor's interest to, kind of think about revenue-based financing through the lens of companies that are post-revenue. I think one important aspect to WeFunder is the brand, the marketing, the promotion, the ability to tell your story to the masses. So WeFunder is naturally attracted, consumer-facing brands, and that's been a sweet spot for us, mostly for the fact that if you can get your customers to invest, they're going to be more repeat buyers. They're going to have better virality. This is good for the brand if customers are investing in the company, and that's really at the core of what WeFunder is. So I think that's been kind of the sweet spot in terms of like what companies are best designed for WeFunder. RBF is like consumer facing brands that are post revenue would probably be the broadest stroke kind of like target market for me.
No, I think that makes sense. Definitely want to be post revenue, and I think you kind of said it earlier in the presentation on, if you're more of a linear growth company, and also I think you got to have the factor of like you got to have a community, you got to have people, in your network that have the capital or would have the belief in what you're doing, and have a way to kind of monetize from it as well. As an alternative to equity financing, which can be a little bit harder of a sell. We did get an interesting question that I'd like to answer that just came in of, will VCs like WeFunder being on the cap table? Well, correct me if I'm wrong, Justin, but in this case, WeFunder's not on the cap table with this instrument. It's effectively like debt. And debt is more on the balance sheet, not so much on the cap table. I think from most VCs, there are plenty of crowdfunding campaigns that have gone on to raise venture capital. It's more of did you make good use of the crowd equity capital that you raised, and did you take it to the next level and become a venture backable startup? That's more of what they're going to be judging you on. If they see you as a WeFunder, if you're actively running WeFunder and you don't have momentum, you don't have track, it's really about your business and your growth and your execution is more of what they're judging you on, less so much the fact that you chose to do a crowd campaign. Because like Substack, which raised hundreds of millions of dollars from Andreessen Horowitz and other big like Mercury, have all done crowd campaigns to engage their communities, and to kind of give their customers, their users, their believers an opportunity to invest. So it really just it's circumstantial, and it's more about just because you want venture capital doesn't mean venture capital is going to come to you.
And to layer onto that mechanically, on the equity side for companies that are raising on safe and convertible notes, all investors are pooled into an SPV, so it's just one line on the cap table. So that was a huge shift for our industry, was taking retail investors. It's like if you have 100 investors and now you have a 100-person cap table, that's going to be unattractive to a VC. But the fact that it's just one line and it's on a kind of standardized SPV in the same spirit as YC, we haven't. That pushback has subsided to a great degree.
Yeah, and that's more what VCs are concerned about, is these extra long cap tables. I know many founders that kind of have these rolling raises because they need to get things working, but they can't necessarily pull off getting a big check, and they have these $10,000, $20,000 checks on the cap table, which can definitely hurt their odds of raising capital, just because it becomes messy. It looks like you struggled and maybe you weren't succeeding or something. That could be negative signal for some VCs. It's a harsh reality, and I've done it. One of my companies, we had I think 40 or 50 angels on the cap table before we raised any institutional capital, and we still raised $12 million and sold to Walmart. So there's definitely case studies out there that it's not much of an impact. It's a logistical and legal nightmare of more of what it is, and VCs would choose rather not to participate. And just because your cap table is messy does not mean that's not the reason they say no. That's just an easy, kind of excuse to pull out of a deal. But what's nice about WeFunder and other solutions, like Justin was saying, is it's basically wrapped up into an SPV, so it's just one entity on the cap table, keeping it nice and clean, as opposed to the hundreds of potential people.
Can I ask you a question? Hey, first of all, it's super interesting, very creative, and well explained. So thanks, and sorry for joining late. But I'm fascinated by this, just from a real neat, like kind of nuts and bolts perspective. And forgive me if you've already covered this, but what are you seeing? First of all, how long has this been going on? What are you seeing in terms of like typical campaigns? How much are people raising? How long does it take to kind of like go from starting this to actually like closing on the round? Yeah, so like just sort of like some basics of like what's involved as a founder to kind of like run one of these successfully.
Yeah, WeFunder's been around for a decade, so we've been, executing campaigns on both the debt and equity side for a long time. The process is the same across, whether it's revenue-based financing or whether it's equity, it's the same process. The only difference is the contract. So what are you offering to investors, and what is the premise of this raise? What is the exchange between founders and investors? In terms of the onboarding, all founders create a campaign page, which is more or less a flushed out pitch deck. It's got, a lot of times there's a campaign video, you have bullet points on the company, you have your pitch deck, there's a Q&A, you have updates where you can talk about what's going on with your business. That campaign page is kind of the basis of your raise. And you're able to start a campaign page, in a day. You could use the existing assets that you have to come up with a good V1 very, very quickly. And that campaign link is shareable. So it's like you create a campaign page, now you have a URL, you send that URL out to investors, you start bringing in checks. So that process is very simplified in terms of the mechanics of getting set up on WeFunder. All the work goes into getting checks. Getting checks is the hardest part. And a lot of times that kind of starts in the inner circle where it's like people that investors that you've already spoken with, starting to send this out to select customer groups. And then it kind of expands as you go out, raising from bigger and bigger pools of people to put the capital together. Arrived was a VC-backed company that launched in June. They raised $9 million in a day, and it was a very efficient fundraise. Most companies, fundraise over the course of weeks or months, but it really depends on kind of where you're at. I've had many companies raise 124,000 and close it off. Let's raise 124,000 super quickly. Let's cut it. Now, 124 is a random number. To raise through any crowd-based, platform, you need to file a Form C. A Form C requires financial disclosures. At $124,000 or less, it's self-reported financials, very easy to put together. We can turn the Form C around in a couple of days. And that's the point at which you have access to the capital and we can start sending you money. If you raise between 124,000 and 1.2 million, you need reviewed financials from an independent CPA. That generally costs $5,000 and takes about 3 weeks. So that kind of delays the filing process. And then if you raise between 1.2 and 5 million, you need audited financials for 2021 and 2022. That costs a lot more and takes a lot more time. So it's kind of a tiered approach in terms of the financial disclosures and the ease at which you file through this, SEC required paperwork.
That makes sense. Robert, I believe, had a question if he wants to chime in. He had his hand raised a moment ago.
Yeah, thank you. I'll put my hand down. So we're actually very active in pursuing this. I've been looking at it for a long time. One of the very first revenue share raises was done here in Austin, Texas by a brewery, North by Northwest. Yep. And I had a chance to take a look at that, and I've just been trying to get to the point where we can do it. And one of the things that I did is I started talking to some of my friends and family about an angel round. And what was discovered is two things. One is that maybe they're not willing to put in a large amount of money, and also many of them aren't actually accredited investors. So what we're going to go back out around again. I only talked to 2 or 3 of them, and they were all positive. But what I got the feeling of is that if I had had an outlet where they could have put in, $1,000 to $2,000, the max, they would have done it. It would have made every one of the conversations that I had to find out that they were accredited and now this is a little bit is that it is a little bit of a, if I do that, am I really violating the rules if I just say, hey, we're trying to give you the accredited investor pitch. Oh, you're not an accredited investor. You got to go look at WeFunder.
Well, WeFunder is designed to allow all to, the
Okay.
democratization of, startup investing is rooted in the fact that it shouldn't be limited to accredited investors. So that's kind of baked into every single WeFunder raise is like, you can fundraise from anybody and there's a lower minimum check size. So I look at it from a very opportunistic lens where it's just like, I'll take checks wherever I can get them right now. It does not hurt me to have this vehicle accessible to me for investors that may not fit that 25K plus angel check category. It's like I can still spend my time going out and trying to hunt 25K plus angel checks, but it doesn't hurt to have this in my back pocket for friends and family that might want to come in, folks that want to come in with a $5,000 check, folks that may not be accredited. In many cases, it's kind of parallel processing from a fundraising perspective. And that applies equally to debt and equity, where it's like different strokes for different folks. I have plenty of companies that are exploring a revenue-based financing track in parallel to raising equity from angel investors. I think we paint this really clean picture of seed stage to Series A to Series B. In practice, getting from seed stage to Series A frequently involves many rounds, many bridges, many different ways to get the capital you need to get there.
And I would say that in my experience in talking to these people and then bringing up the revenue share debt, they all just got it. They got it much more quickly than, and they didn't feel like they had to understand. We're in an esoteric business. They didn't feel like they had to understand every aspect of the business to be able to invest in me, if you will.
Right. Yeah. I mean, preaching to the choir on that one. It makes sense might be the tagline of this entire product.
I know you had a question.
I
I'll
was
let you
one of
jump
your
in.
first customers at Kiva. I was doing micro support to some coffee farms down in South America, and I got paid with a huge interest. So I supported it. Now I'm on the other side of the table trying to raise capital. My question is, how much money, or what's the ratio between how much money do we have to put in versus how much money can we raise, right? Is it a 1-to-1 per dollar, or is it 100-to-1, or is it a 20,000 to 1? Like, what's your curve, normal curve, not the exception, but let's say I have a minimal campaign to do this, might cost $1,000 and the fees that we have to pay you guys.
Yeah.
Or what's your perspective on that? And give us a little bit of color in that sense.
Yeah, I mean, I think that's honestly very individualized as to how much capital do you need? Does that amount make sense? The industry benchmark is 1/3 of revenues is a good target raised amount. But so if you're looking at a bell curve, I would say that's where the majority land is 1/3 of revenues is the relevant amount of capital for revenue-based financing. However, I think that in theory and in practice are, not always in sync. I think that it really depends on kind of what's on the horizon. What are you raising capital for? Does this make sense? Do the economics kind of line up based on where you're going? Again, if you look at this from a purely economic sense, you're basing your revenue projections on your revenue history. You know what types of customers you need, how many of those customers you need to kind of achieve an 80% growth rate, 100% growth rate, 200% growth rate, whatever makes sense in your industry and your business.
And how much, I'm also referring to how much will it cost us, right? As entrepreneurs, do we have to pay $1,000 to access the platform, or to support, we have to do a marketing campaign to bring in customers? What's part of the journey there?
I mean, It depends. I don't think most companies spend money on paid media. I don't think paid media works. I think investor acquisition was like a fad of 2020. It is no longer working. So I strongly discourage founders from running up big marketing budgets. I think this is a more honest approach where it's basically like, I'm going to offer something of value. It's a healthy exchange of risk and reward. And I'm going to offer that to people in my orbit. And customers are in your orbit. Friends and family are in that orbit. You have a professional network that's in that orbit. That's the exchange that you're offering. And, in most cases, it's being generated by the founder to build momentum. I'm a strong advocate against, paid marketing campaigns to acquire investors.
Awesome. And just one more time for everyone, what is the fee that WeFunder charges on the capital raised for the
it's a little
revenue-based
different.
financing?
It's
The same as the equity? Is it a little
7.5%
different?
on the equity and 6% for revenue-based financing. So it's just a flat percentage over the course of the raise. There's no other fees associated with raising on WeFunder.
Okay, so basically, you raise let's call it $200,000. We'll go ahead and mute Adam there. So effectively you raise $200,000. You do a 2x. You're effectively on the hook for paying back. I guess in this case, $12,000 is going to go to you guys, and then they're going to have to pay back in total like $412,000 is basically what it comes out to be based on whatever time schedule and revenue goals they hit and whatever. But effectively,
the
the
2x.
payback is that
plus
2x
the 6% to WeFunder.
Right. Okay. And so, no, that makes perfect sense, and I think that's an option that founders have at their disposal. That, I think it really comes down to if you have the network, and if you have it, and you have the community that believes in you, you could basically make any business fundable based on the community, which is awesome. Whereas some more traditional revenue-based financing solutions out there, it's strictly based on the kind of the financial.
Totally legal to announce this to the world, or it has to be done on separate channels?
Yeah, that's part of WeFunder is opening it up to accredited and unaccredited investors and solicitation. So being able to post on LinkedIn, on Facebook, you're able to kind of mass promote this.
Okay, that's good news.
Yeah. And I agree. I agree with you fully, Jason, where it's basically like if you have customers that love you, if you have a community that loves you, if you have friends and family that really believe in you, part of my desire in launching this product was through the lens of my boat business. My boat business probably wouldn't qualify for a traditional loan. And I probably wouldn't want to take a traditional loan because I don't want to put my house on it. That's just too far of a stretch for me. I think the personal guarantees and collateral for me make taking out bank debt a hard sell. So then you look at equity, and it's like equity in a boat charter company. This is a side hustle for me. That doesn't make any sense. If I were to raise, let's say my marina was like, here's 5 more slips. You can run 5 more charter boats. I would jump on that opportunity, and I'd probably need $150,000. This is what I would use. This is the most pragmatic option for me to be able to raise capital, buy boats, give investors a great deal, something that I feel good about. I believe there's a good risk reward and exchange of value in how I would fundraise for my boat business within my network. It would just be people that I know. I'd be calling Jason and giving him, here are my financials. This is why it makes sense. And, I'd be going to everybody that I know, all 300 LinkedIn contacts. I'm trying to go one-to-one to basically be like, hey, help me raise this $150,000 so that I can 5X my revenue.
Exactly. Well, that said, are there any other questions from anyone that's on here or on LinkedIn? Justin, any kind of final notes you want to conclude on? I did post, actually, just for everyone's reference, if you guys want to get in touch with Justin or you want to talk more about the revenue-based financing, I did post a link for a form to fill out to get in touch with Justin on this topic. And if you guys have any further questions around it, happy to field those questions.
No, I actually didn't
Justin just
post
posted
the
the form there
form.
as well.
In final words, yeah, in final words, I just wanted to kind of like talk about fundraising. I think that mindset is everything when it comes to fundraising, whether you're a Series A founder or raising your first round. You have to have grit. You have to hustle. You have to make it a priority. You have to put the time into it. You have to be resilient and be able to take those no's and have those no's fuel you rather than slow you down. I've worked with hundreds of founders on fundraising, and I believe that there are core traits to fundraising that are rooted in just mindset. I think mindset is everything when it comes to fundraising. Having a will to win, having conviction and confidence in what you're building, being able to just keep going. Those are core tenets of entrepreneurship, core tenets of fundraising. So I posted this Google Doc where it's like my top 8 traits for kind of mindset as it pertains to fundraising. I don't think it's any different with revenue-based financing, with equity, with bank debt. It's all just like it's a game of will. So I suppose if I were to leave on one note, that would be the note that I leave on.
Justin, I really appreciate the time. The time today. I think everyone really got a lot of value out of learning about this, not just kind of new offering, but just how it's structured and how it's being used. I think was very insightful for everyone that participated. And for those that weren't able to make it, obviously this will be recorded. We'll be distributing this out to our network on our YouTube. And if you guys aren't aware, for those that are paying attention, we have a new podcast that you guys can check out called Fundraising Demystified on all major platforms. The website, the WeFunder website is down. Just a fun fact. We discovered that on the call. Great timing. Hopefully, it'll be up by the time of recording. So,
You're full, Justin.
I've gotten like 800 texts over the course of this.
You're selling, man. You're selling.
So, not like you can do anything about it. Especially someone that's probably doing a campaign right now would probably be a little frustrated. And then we are doing deck reviews. So we do a weekly deck review Friday, 1 p.m. Eastern. We'll be sending out more information about that. But every Friday, I'll basically it's like kind of an open office hour where I'll provide full-on deck reviews for anyone that submits them in advance. So if anyone's interested in that, by all means, you can check that out and sign up for that and participate in it live or watch the recording after the fact. So that's going to be every Friday, 1 p.m. Eastern moving forward. That said, Justin,
thank you so much.
Appreciate the time. Thank you everyone for joining us, and we'll get this recording out as soon as we can.
Bye-bye.
Thanks.